Companies Act Section 41, Global Depository Receipts, GDRs. 1. Issuance of Global Depository Receipts, GDRs. Under Section 41 of the Companies Act, a company has the legal right to issue Global Depository Receipts, GDRs, in foreign countries as part of its efforts to raise capital in international markets. GDRs serve as a financial instrument that allows a company to tap into foreign investment by issuing shares in a form that is tradable in the global financial markets. Approval process through special resolution. Shareholder approval. The issuance of GDRs must first be authorized by the company's shareholders through a special resolution passed at a general meeting. A special resolution is a formal decision that requires a higher level of agreement than ordinary resolutions, ensuring that a significant portion of shareholders are in favor of the action. What is a special resolution? A special resolution typically requires at least 75% of the shareholders present and voting to agree to the proposal. This high threshold ensures that the decision to issue GDRs is not taken lightly and reflects a broad consensus among shareholders. The resolution essentially acts as the shareholders' consent, approving the company's intention to issue GDRs and enter into foreign markets. Purpose of shareholder consent. By requiring shareholder approval, the Companies Act ensures that significant decisions, such as the issuance of GDRs, are made in a transparent and democratic manner. This protects the interests of the shareholders by giving them a direct voice in the company's decision to seek international investment. 2. Conditions and procedures for issuance. While the ability to issue GDRs is granted, companies must adhere to specific conditions and procedures that are set out by relevant authorities. These regulatory frameworks are designed to ensure that the issuance of GDRs complies with legal standards, both in the company's home country and in the foreign market where the GDRs are being offered. Regulatory conditions. Domestic and international regulations. The issuance of GDRs is subject to the laws of the country where the company is incorporated, domestic regulations, as well as the rules and regulations of the foreign jurisdiction where the GDRs are being issued. This ensures compliance with all necessary legal frameworks, reducing the risk of legal violations or conflicts between different regulatory regimes. Compliance with Securities and Exchange Board, SEBI. In India, the Securities and Exchange Board of India, SEBI, may provide specific rules and procedures regarding the issuance of GDRs. Companies must follow these rules to ensure they are meeting the standards required for such international transactions. Why conditions and procedures matter? These regulations provide a structured approach to issuing GDRs, ensuring that the process is fair, transparent, and legally sound. They also protect investors by ensuring that companies issuing GDRs have met the required due diligence and regulatory standards before offering their securities to foreign investors. 3. Purpose of Global Depository Receipts, GDRs. Global Depository Receipts are used as a means for companies to raise capital in foreign markets by offering their shares in a form that is easily accessible to international investors. GDRs act as negotiable certificates issued by a foreign depository bank, representing a specific number of shares in the issuing company. They are a popular mechanism for companies seeking to expand their investor base beyond their home country. How GDRs work. Underlying shares. GDRs represent a set number of underlying shares in the issuing company. These shares are held by a depository bank in the foreign country, while the GDR itself is traded on international stock exchanges. This allows foreign investors to invest in the company without directly owning the underlying shares. Capital raising in foreign markets. GDRs provide companies with the ability to raise funds in foreign currencies, accessing a broader pool of international investors. This is especially beneficial for companies looking to diversify their investor base, reduce reliance on domestic capital markets, or gain exposure to global markets where there may be more liquidity or higher demand for their securities. Advantages of issuing GDRs. For companies, GDRs offer the opportunity to raise large amounts of capital quickly, potentially at a lower cost than through domestic offerings. For investors, GDRs provide access to foreign companies' shares without the complexities of cross-border transactions, making it easier to invest in international markets. 4. Regulatory compliance. Issuing GDRs is not simply a matter of raising capital, it involves strict regulatory compliance. Companies must ensure that they are following all applicable guidelines and rules, which are often set forth by regulatory bodies both domestically and in the foreign jurisdiction where the GDRs are to be traded. Key compliance obligations. Adherence to foreign jurisdiction rules. The rules governing the issuance of GDRs vary between different countries and stock exchanges. The company must ensure that the GDRs comply with the rules of the foreign stock exchange on which they will be traded, as well as the foreign securities regulations that may apply to international investors. SABI regulations. In India, the Securities and Exchange Board of India, SABI, provides specific regulations governing the issuance of GDRs. The company must follow these guidelines to ensure that the GDR offering adheres to Indian securities laws and international best practices. Investor protections. Compliance with these regulatory standards is critical for protecting both the company and its investors. Regulatory authorities ensure that the issuance is conducted in a fair and transparent manner, reducing the risk of fraud or misconduct in the offering process. 5. Special resolution requirement. The need for a special resolution to authorize the issuance of GDRs is a critical part of the decision-making process. A special resolution reflects the consensus of the company's shareholders, ensuring that they are in agreement with the decision to pursue foreign investment through GDRs. Shareholder involvement. Voting process. The special resolution is typically passed at a general meeting of the company's shareholders. During this meeting, shareholders will discuss the proposal to issue GDRs, consider the terms and potential benefits of the offering, and then cast their votes. Threshold for approval. As noted earlier, a special resolution requires at least 75% approval from the shareholders present and voting. This higher voting threshold ensures that a significant majority of the shareholders are in favor of the decision to issue GDRs, reflecting a strong endorsement of the company's strategy to raise capital internationally. Why special resolutions are important? The requirement for a special resolution ensures that important decisions, like the issuance of GDRs, are made with the support of the company's shareholders. It helps maintain transparency and accountability in corporate governance, protecting the interests of the shareholders by giving them a direct say in major financial transactions.